Greetings, members one and all of the Salivation Nation. A look at the lumber to gold ratio to predict the markets. No, this is not a prank. This is a plank. Wouldn't you know it? Let's explore. Most of us are very well aware of rising commodity prices, but lumber has really brought the attention for many in the construction industry. In fact, recent news reports have said that construction has slowed now because of the rising lumber costs. Well, in the last few days, we have seen lumber prices go down fairly dramatically, but we've also seen gold and silver take a pretty big hit as well as most commodities. There's an article I'm going to be referencing here from MarketWatch that talks about how lumber and gold prices, what they can tell us about what's going to happen in the stock market, or maybe not. We've seen the biggest plunges of lumber in history, with the spot futures contracts dropping more than $670, or 40%, in just 25 trading sessions. It's human nature to try to find some meaning in all of this, since the alternative is to accept these price changes. This momentous are nothing more than merely random fluctuations. None of us like to accept that our investment portfolios could be subject to such cruel twists of fate. But we also understand that these cruel twists of fate are based off of psychology. What are people reacting to in the marketplace? It can be something very small or something very large, and sometimes those large things that one would predict could influence the markets have very little effect at all. One way in which some are finding some meaning in lumber's decline is via a market timing indicator based off of the lumber to gold ratio. That's right, and one study found that when the ratio is higher than where it was 13 weeks previously, conditions should be favorable for U.S. stocks. When it's lower than that 13-week period, U.S. Treasury bonds are preferred. But not surprisingly, given lumber's recent plunge, the ratio's current message is bearish for stocks. To help determine how much weight to place on that message, the ratio back to 1984 has been tested, which is how far back data extends on FactSet. For each of the weeks since, the ratio was higher or lower than where it was 13 weeks previously. So 13 seems to be the number that we're looking at here. And we saw there's actually a graph that was been plotted from FactSet that shows how high that lumber to gold ratio was. And it was just a few weeks ago when it was almost at 400. It's crazy. The table that shows a frequency of a rising market as a fluctuation of whether the lumber gold ratio's 13-week change was positive or negative. And there was a Wilshire 5000's total return index as the benchmark. And, Wilshire is a much broader view of the market than the Dow. Wilshire measures 5,000 companies. And so when the ratio is higher than the 13 weeks previously, the percent of time that the market is higher over the subsequent month was 66%. And the same when it was lower than 13 weeks previously, it was at 65%. So not a whole lot of change different there. So on average for all the days, it was about 66%. Over the quarter, it was a much higher return, 74 to 72, and averaging out about 73. And then over the previous year is where the measures are a little bit more pronounced. When it's higher than 13 weeks previously, it was at 86%. When it was lower than 13 weeks previously, it was at 78%, with an average of 82 over all the days. So it really makes a little difference to the frequency of a higher stock market. The suggestion that the recent downturn in the lumber-gold ratio may not be as alarming as it otherwise might appear. But I think it does tell us that, lumber was in great demand because the housing boom is quite obvious. I think that's the biggest thing, and I think that's why the lumber to gold ratio was so high. And this big boom was just exacerbated, and then on top of that you have inflation, which cannot be ignored for sure. It's possible that even though a decline isn't more likely when the ratio's 13-week change is negative, the declines that do take place are more severe. And so that is something to take into account when you look at it measured through some of the same standards that we put before. It's not really an exhaustive analysis, by the way, of the lumber to gold ratio potential value. Very rarely do you see those two measured against each other. Usually it's oil to gold. And obviously we know the dollar to gold ratio, the dollar index, and that's the most important measure for sure. But it's the price differential between these. But lumber has been a precious commodity. In fact, I was helping a friend of mine on his construction site for his house, and we are having to fabricate a couple of pieces of small bits of wood in order to utilize for some other projects. And some of this wood was not the best, but hey, we were scrapping for every piece we can find. And the data is not going to really suggest that the recent downturn in the lumber price, the gold ratio, is not in itself a huge cause for alarm. None of these results guarantees the stock market won't experience a correction in coming weeks or even begin a bear market. We all know how overvalued the stock market is. It is in a bubble. A lot of that is from liquidity from the Fed. And the decline in lumber to gold ratio is not an additional reason for predicting necessarily a downturn. Both lumber and gold have dropped in prices. But the thing is that through this, there is something else to take into consideration here. There's another ratio, and that is the gold to platinum ratio. And that is something that I think is probably even a better predictor and an analytical standpoint here. And that is something, the ratio is a lot lower today than is set at the bottom of last March's waterfall decline, they're calling it, but the huge drop still is above this long-term average. Accordingly, although the stock market's upside potential is over 12 months, is nowhere near as strong as it was a year ago, still above average. But I'd say it's to watch that platinum to gold ratio too, because historically, given that platinum is more rare, it is more volatile, we very well could see platinum go up above gold, just as palladium has. But there's a lot of things that have to happen, I think, in the meantime to make that occur. And there's some things working against platinum as well. But I think overall, I think it's good to have a little bit of it in the stack. And hey, I got this little piece of wood. You think this was a good investment? All right, yes, indeed. I don't know. I'm going to hold on to it. This one, by the way, is pressure treated, and it smells delicious. So there you have it. All right. So what are your thoughts about the lumber to gold ratio and the platinum to gold ratio? And it is something that, hey, we'll have to keep an eye on. I think in the long term, it's good to have this metal in your stack, gold for sure, and maybe a little bit of platinum. And, hey, it may not be a bad idea to stack a little wood too, but I think the wood shortage and all the supply chains are coming together. And so hopefully we'll see that thing occur to where we can get back to some sense of normalcy, but there is no such thing in these days. I don't think it's going to be a long time before we're back to normal. There's so many things that are working against the overall general health of the economy, but we'll see how it plays out. So there you have it. Let me know your thoughts in the comment section below about the lumber to gold ratio and how it may or may not predict. I don't think it's really necessarily the biggest predictor, and it sounds like from this article that he's saying that it has a negligible effect, but it is somewhat measurable. Negligible, but measurable. And we'll see. All right. Gold. Lumber to gold ratio. Very good indeed. All right. Let me know your thoughts. I'd like to extend a multitude of gratitude to you all and for taking the time to watch this video, and encourage you to please rate, share, comment, and subscribe.